Hi, everyone. I hope you're doing well. My name is Boca, and this is the second part of a three-part video lecture on the application of matrix algebra to modern portfolio theory. So if you haven't seen the other video, I'll go ahead and put a link to that in the description. Please check that out as it'll be an important prerequisite for some of the basics of matrix algebra that we go over today. So I'll have the timestamps for the video in the description. So some of the concepts in the beginning of the video might be a little bit more basic for those of you who are further along in the class. And specifically for those of you in the 506 quantitative finance class, for assignment 7, this should be the only video that you need. So the third part will mainly be relevant for your upcoming midterm and also the project. But you can go ahead and take a look at that video when I upload it, but this will be the only video that you need for the completion of assignment 7. So go ahead and take a look at the timestamps as well. You might need to skip a little bit forward if you're already familiar with some of the prerequisite concepts. But yeah, without further ado, I'll go ahead and dive right in. So just a basic review of modern portfolio theory. This is a theory that was propounded by Harry Markowitz. And before this, essentially people were looking at stocks and they were valuing them mostly based on their internals. So trying to calculate, what's like the fair market value for a stock like Tesla, and trying to see, using fundamentals as a measure of the risk of the investment. And essentially Markowitz was really big for propounding the theory that you don't only need to look at the volatility of returns. You're basically looking at that in conjunction with the covariance of returns. When we're thinking about returns, we want to be looking at like the volatility. And if we're making a portfolio that combines assets, we need to look at how the volatility of the returns moves together. So I'll start with some of the conceptual reviews, right? The variance. So we have returns. If you invest in a stock, your returns are going to change from month to month. So looking at how the returns, the variance changes. So this would be a low variance stock versus a high variance stock. This is a pretty basic review of some of the concepts we've gone over. Again, feel free to skip ahead if this is rudimentary for you. We're going to go over the Sharpe ratio, capital allocation line, and efficient frontier now. So the Sharpe ratio, this essentially measures how much excess return we're expecting as a ratio of the risk. So you're essentially asking, like, how much can I expect to receive above the risk-free rate, this excess return per amount of risk I took, this standard deviation. So what gets interesting is we're using volatility and standard deviation. A little bit later in the course, we'll talk about how we actually get those measures and whether there's better measures than using the historical volatility. So maybe something like a time series measure of volatility. We'll see why this is important when we get to later aspects like the Black-Scholes model and things like that. But for now, just know that we're using historical volatility for this would be the historical standard deviation. Okay, so the capital allocation line, this represents the formula for this would be the risk-free rate plus the Sharpe ratio times the standard deviation of the portfolio. So looking at this graphically, right, on the x-axis we have standard deviation, and on the y-axis we have returns. So where this line intercepts, where the y-intercept is the risk-free rate. So this is the minimum return we would get for zero risk. So something like buying a 10-year bond, right? Something that doesn't have any variance in returns. So that would be the intercept. And then anywhere along this line represents the best possible combination of a risk-free asset and a risky portfolio. So that portfolio that we have, which is like a combination of the risky assets, so various stocks or things like that, that will have a certain risk, so a certain standard deviation, and that will correspond to a certain value on the capital allocation line. So the risk-free plus Sharpe multiplied by that standard deviation will get the value on that line. And the difference between that and the risk-free rate will be the excess returns to portfolio. So points below this line basically represent inefficient combinations of the portfolio assets, as essentially you could be getting a better return by combining a risk-free rate uh, with that portfolio. Now the efficient frontier, this is basically a measure of the best possible combination of risky assets without looking at the risk-free rate, without looking at the risk-free as a possibility for another investment. So basically, where this efficient frontier, which is like various portfolios, where that intersects the capital allocation line, that would be the tangency portfolio. And that represents the points where the optimal combination of these various risky assets meets the optimal combination of the risky and the risk-free portfolio. So this is the Markowitz solution, right? The portfolio optimal mean variance optimal portfolio. So this basically minimizes the amount of risk. It maximizes the return and minimizes the risk. So this point would be the weights that correspond to this point would be your optimal weights. Okay, so now let's go over some of the application of that. So basically, some of the questions that you might have on exams or some of the situations you might encounter are two asset versus more than two assets, right? So if you're picking between, you're trying to find the optimal portfolio for just two assets or more than that. And then within that, you have three sort of optimization problems that you might see on exams. So the Sharpe ratio maximization would be like the typical normal optimization where you're basically trying to maximize the returns above a certain threshold, so the risk-free rate, and minimize the variance of the portfolio. And then you would have global minimum variance where you're just minimizing the variance of the portfolio subject to the weights just have to add up to one. So this would just find your minimum variance. You know, I'm very risk averse. I don't care about getting above a certain amount of returns. So we'll get into those in more detail, but for now, just know that all of these two have all three of these as a subset for each of them. So for the two asset, this is the formula for the variance, right? We have the variance of the portfolio, the first weight squared, first variance squared, plus second weight squared, times second variance squared, plus 2 times the first weight, second weight, times the covariance of the assets. So I included the formula for the covariances over here. You can go ahead and check that out, but that's going to be important. This is basically how the returns, the variances move together. So that'll be important for the matrices later. And that was basically Markowitz's big contribution as well, was we have to note not only how the individual assets, how their returns shape, you know, how their returns vary. Sometimes two assets variances might be very similar, and we have to investigate whether there's a covariance between those assets as well. So then the formula for the return of the portfolio would be the weight of the first asset multiplied by the return of that asset plus the weight of the second asset multiplied by the return of that asset. So now I'm going to talk about three asset as a segue for the matrices and the benefit for using these, right? So as we can see, the return formula is pretty simple. You have three assets, A, B, and C. You're just multiplying the weights by the returns to get the return of the portfolio. But the variance of those returns, gets exponentially more complicated as you increase the number of assets. So as we can see, this is just for three. This is what the formula looks like for the variance of the portfolio with three assets. And obviously beyond that, it becomes pretty impracticable to calculate it. So the idea is to reframe it in terms of matrices, right? So now you can have any number of assets, but you just put their weights in a column vector, and the return of the portfolio would be the transpose of that vector multiplied by a column vector of the expected returns. So this would just be a historical measure of the average returns over a period of time. The variance would be the transpose of the weights column multiplied by a variance covariance matrix. And remember, the variance covariance matrix, looks something like this. You have asset A, asset B, asset A, asset B. You have the variance of asset A, the covariance of asset A and B, covariance of asset A and B, and the variance of B. So essentially, you're multiplying the transpose of the weights by this variance covariance matrix. So as we can see, this is significantly simpler than trying to actually multiply it out and solve it that way. So this way we could just take the inverse of the variance covariance matrix, and then multiply it by either a vector of ones or the excess return matrix to find the unnormalized optimal weights. And we'll get into that, but yeah, for now, just see that it's simpler if we make it matrix form. For the Sharpe ratio maximization, right, this can be either two asset or more. The two asset, it's a little simpler. We just take the formula that we know for the variance. So we're setting up the problem. We're minimizing this variance formula subject to the returns have to be greater than the risk-free rate, because otherwise we would just invest in the risk-free asset. So for this, we need to set up a Lagrangian function. And I didn't make a video on that. I may make a video of that, or otherwise I might just refer you to another video. But for now, just know that, yeah, I'm not going to go too much into that, but this would be how you set up the Lagrangian function for the two asset portfolio. So the Lagrangian function would equal the weight of the first asset squared. It's essentially just the variance formula plus the Sharpe ratio multiplied by, this is the constraint part of it. So the Lagrangian function would equal essentially the variance portion plus the Lagrangian multiplier. And remember that this is different from the Sharpe ratio in this context, multiplied by the constraint function. So essentially the RF minus the first weight multiplied by the first return minus the second weight multiplied by the second return. So remember to set it up like this as well, with the risk-free rate minus these functions. Now differentiating with respect to the first weight, the second weight, and the Lagrangian multiplier, essentially will get you these unnormalized weights, these z equations, once you solve for so differentiating with respect to the first weight, the second weight, and the Lagrangian multiplier, essentially you get these equations when you solve. So these would be the formulas for the unnormalized weights. And once you have those z values, you can divide them by the sum of the z values to achieve the normalized weights. So this would tell you the actual weights of the assets, how much you should invest in each. For more than two assets, right, this is where it became tricky earlier. I'm not going to go super deep into this just because I don't want to lose anyone in the weeds, but basically we're minimizing the variance subject to the returns have to be greater than the risk-free, and the sum of the weights have to equal 1. So where R is a column vector of the average returns, right? You set up the Lagrangian function like this with the transpose of the weights multiplied by the variance covariance matrix plus the Lagrangian multiplier multiplied by the risk-free rate minus the transpose of the weights multiplied by the return column vector. So essentially when you differentiate with respect to the weight and lambda, you get these two equations. And essentially solving this, to make, a long story short, you are multiplying the inverse of the variance covariance matrix by the risk premium matrix. So this would be the returns above the risk-free asset. So you basically take the return vector and subtract the risk-free vector. And that would get you the unnormalized weights. So you still have to normalize these just like the previous problem. Basically, all we need to know for that one, for the global minimum variance, this would essentially be, so the Sharpe ratio maximization point, that would be the tangency portfolio point. But the global minimum variance is essentially the point that's on the very left, the leftmost point on the efficient frontier. So without this capital allocation line, you're just looking at the efficient frontier. It's the point that's on the very left. So that would be like this point, right about like here. So that would be a very risk-averse investor who just cares about minimizing risk. So the only constraint is that the weights have to add up to 1. What's nice about this is it means that the second weight is just 1 minus the first weight. So when we differentiate the quadratic variance equation with respect to W1, after we substitute, I guess I should have said WA, after we substitute, we get these unnormalized weights, right? These are the formulas for the unnormalized weights for global minimum variance. So you see a question on the test asking for the global minimum variance with two assets, you can just go ahead and use these equations to calculate the unnormalized weights. And then once you normalize those, you'll have the weights for the global minimum variance portfolio. So that would be for a 2 asset. For an n asset, we're minimizing again that that variance of the portfolio equation, and then subject to the weights have to add up to 1. So for the solution, this one, instead of multiplying the inverse of the variance covariance matrix by the excess return matrix, we're actually just going to multiply it by a matrix of 1s, because that's just going to enforce our constraint that the weights have to add up to 1. So all we're doing is we're gonna see how we use the solve function Actually, this is going to be in video 3. So yeah, same for the Sharpe ratio maximization. We go over these ones in video 3. But for now, just know that this is how we would solve it, right? This is how you would get the unnormalized weights, the inverse of the variance covariance matrix multiplied by a vector of ones. And then you would normalize the weights by dividing each element of the z vector by the sum of those values. So the last one is the investor preference. This one I'm really not going to go over. This is just a corollary to the Sharpe ratio maximization problem. With this one, we're instead of minimizing the risk, we're maximizing the returns, subject to the risk has to be below a certain investor tolerance. So I think if anything, I might do a separate video on this one, but for now, we're mainly going to stick to the first two, which are global minimum variance and Sharpe ratio maximization for the 2-asset and n-asset portfolio. So I think that's all of the concepts that are necessary. Now we're going to go into the RStudio code. So now that we're in RStudio, the first thing we're going to want to do is make a new R Markdown file. So the plus in the top left corner and then R Markdown. You can call this whatever you want. You can call it mean variance optimization to asset. You can set the output to HTML document for now. And then that will generate this R Markdown file with a bunch of code that you can go ahead and delete. Everything up to this. You have to leave the first 6 lines of code. And you can actually modify within this to set things like a table of contents or things like that. The R Markdown, I think it just makes it easier to separate out the code from regular text. Just a brief, introduction to this environment for those who haven't seen. In R Markdown, you add code by hitting this little C in the top right. And then you can just hit R. You do all your coding within this space here. This global environment is where you can access various objects that you make and various data frames, things like that. Plots is where you'll see all the plots that we actually generate. But in our Markdown, it'll actually just be right below this. You can hit the code, you can start the code, run it by hitting this little arrow. Or you could also press Command Enter or Control Enter if you're on Windows to run the chunk. And then anything outside that will just be text. So we have a hedge fund that's allocating $50 million to a politically hedged subversive ETF strategy. Basically, I found these 2 ETFs, Cruise and Nance, that represent subversive ETFs from unusual whales for Republican and Democrats trading. So essentially, I don't know whether they mirror these trades or they just have an index of the various assets that they're invested in. But yeah, so we're testing what is the optimal allocation between these 2 assets, both ETFs, both risky. Yeah, but just to see what they look like, here is the Democrat ETF for Nance. Over the last year, it's risen 27%, looking pretty good. Cruise, we got 17%, not bad. So if we want to test how much we should invest in each, we're going to just long shares. And the first thing we're going to need to do is install and load the necessary packages. So for this, we really only need quantmod. And I like to use an if statement here. So if we require quantmod, then we're going to install packages quantmod. So we're mainly using quantmod uh, for this video. This is really a useful package for various financial applications, importing data, manipulating it, and plotting it. So that's mainly what we're going to be using. And then we also want to reference it. Library quantmod is how we reference it. So yeah, we always need to install and reference. Then we're going to get the data for the last 1 year. So put that in an object. We will create an object and we'll use the function get symbols. Combine. So cruise is our first. Nance. And we're also going to use the 10-year bond for our risk-free rate. Now, I'm going to use the argument dot global environment. I'm not sure if it's 100% necessary. I like to do it just to make sure that the objects will be available in the global environment, not just the local one, because I think local is the standard. Now we want the source to be Yahoo. And I'm just going to do it for the past year because we only have a year of data. So we'll do it from the current system date. Sorry, this is capital D. Minus 3652 system date, which is the current date. Now we want to return. We want to make sure our return class is a time series because that'll make it easier to manipulate with matrices. So now we can return assets. And we can actually just take a look at this. Yeah. So we'll fix the fact that TNX contains missing values, but for now we have our assets. Next thing we need to do is convert prices to returns. So we'll do return cruise. And here's where we're going to fix the missing symbols. So we're gonna do NA omit, which is removing the missing values. And the reason we need to do this is because when we do the difference of logs, this is basically just picking a specific column in cruise. Because if we do view cruise, right, we can see that this column is what we need. We need the adjusted prices. This will adjust, this is the closing price adjusted for dividends. So that's what we're going to use. So we're going to take that column and find the difference of logs. So this is one way to find the returns. The other way is with the discrete formula, which would be using, it would be this value minus this value divided by this value. which would be the discrete returns. So the period ahead minus the period now divided by period now. The reason that we're going to use log returns is that we're using daily data. So it's a little bit shorter of a time frame. And this also, there are nice properties about log returns. Like log returns tend to have a more symmetric and Gaussian sort of normal distribution. And also the time additivity perspective. So specifically being able to subtract the log values to get the returns. So that's why we're just taking the difference of the log values. So it's a simple mathematical function. And we're going to do the same for Nance. And so for longer time frames, like yearly data, you can use the discrete formula, but I would recommend sticking with the difference of logs in general, especially for shorter time frames for the additive properties. And for TNX, we can go ahead and basically do the same, except we're going to take a little bit different approach. Essentially, it needs to take that TNX adjusted column and divide it by scale it to the current time frame that we're on. So we're on daily, and assuming 252 trading days, we would have to divide it by 252 times 100, or 25,200. So that's adjusting. If you were instead adjusting it for monthly, then you would only divide it by 1200. But I'm specifically doing it for daily, so yeah, unfortunately, the ETFs that I chose were not available long enough. I mean, they became available last year, so there's not enough data. So I'm going to move a little bit quicker through these. Computing the mean returns, this should be fairly simple. So we're say the mean of our cruise would be the mean of this data frame. And the mean would be the mean of returns to Nance. Now we'll compute the variance returns. So the variance of cruise would be use VAR for that. And again, this is where we say we're just taking the time series measure of the variance. We'll see other measures that we could possibly use, like for example, the Garch model later in the course. But for now, we're just taking the standard variance measure of returns. So variance of Nance returns be variance of our Nance. Now we'll compute the covariance of returns. So that would be, call it R cruise, R Nance, covariance, R cruise, R Nance. And this covariance function will return that. So now we'll construct the variance covariance matrix. So the variance covariance values, and we'll use round to just round these numbers. Cruise var, you can just use tab to finish the line. The covariance, comma, variance, and we'll round it to 5 decimal places. Now we'll make the matrix. So use the matrix function, variance covariance values. N row equals 2, and column equals 2. This sets the number of rows and columns. Row names. Now this function will set the names. So we want this to be cruise and Nance. And we can also set the column names. Variance covariance matrix. Okay. And I forgot to close this parenthesis. Now we will construct the risk premium matrix. So we'll use RTNX mean of RTNX. So this will just get us the mean bond returns to use as our risk-free rate essentially. And so the cruise risk premium mean of our cruise minus the mean bond return, so the risk-free rate. Right, we're essentially mimicking the formula risk premium equals return of the asset minus the risk-free rate. So the Nance risk premium will be return of Nance minus the risk-free rate. Now making the matrix, we are again going to use matrix. We're going to round, combine cruise risk premium, Nance risk premium, and we'll round these to 5. Number of rows is 2, and the number of columns 2. Number of columns 1. Now we'll set the row names of risk premium matrix. We'll make those cruise and Nance. column names, line, cruise, elements. So I went ahead and added some optional code just to display some of the statistics. So you can do that with cat and print. So this will just show the actual returns in terms of percentages, and then print the variance, covariance matrix, and the risk premium matrix. So now we'll get into the optimal weights. So for that, the first step is to, like we mentioned, with the inverse of the variance covariance matrix. Set that as solve. So when there's only one object in this solve argument, in the solve function, then it will just find the inverse of that. Now we'll multiply the inverse matrix by the risk premium vector. Use percent star percent risk premium matrix. Get the sum of inverse times risk premium. This would be the z, which is the unnormalized weights. So lambda sum of inverse times RP. Now calculate optimal weights. So now to calculate the optimal weights, so for cruise, we'll take the first item in the inverse times risk premium matrix. So to take the first item, you do square bracket and 1, and then divide that by lambda, which is the sum of the items. For Nance, we'll do the same, but with the second item. Now this will get us the normalized weights. And again, I'm going to go ahead and add some optional code to display the weights. Now we'll calculate capital allocation line equation and graph capital allocation line and efficient frontier. So first we need to find the return, variance, and covariance of optimal portfolio. So for that, we'll do our optimum, cruise weight times our mean plus Nance weight times Nance. So this formula was essentially the return we talked about earlier, the formula for the returns, the weight of the first one multiplied by the return of the first one plus the weight of the second one multiplied by the return of the second one. The optimum variance would be that same variance formula we talked about originally. So this formula would be, so this variance formula would be what we talked about originally, the weight of the first one squared times the return of the first one plus the weight of the second one squared times the return of the second one plus 2 times weight of the first one, weight of the second one, covariance. Now the standard deviation of the optimum portfolio would just be the square root of this variance. Now we're going to input the risk-free rate. So for that, just set the risk-free rate to our mean bond return. Now we'll calculate the capital allocation line. So the slope of that would be the optimum return minus the risk-free rate divided by the standard deviation optimum portfolio. That's the equation we talked about earlier. So we'll set that to be a function of x and where the risk-free rate plus capital allocation line slope times x, that would be the formula. Set those in curly brackets after function of x. So now we have that function, so we can apply it later. So now we'll graph the efficient things here. This will be the next step. So first we construct the portfolio using the 2 stocks. Okay, so I just renamed some of these or set new objects for them, just for the sake of simplicity. So now we are going to talk about 2 scenarios. So where short sales are not allowed. So you cannot sell an asset short and invest that money in another asset. Under those assumptions, the weight, the first asset A would be a sequence 0, 1 by 0.1. So the weights have to be between 0 and 1, and we're going to have the increments go by 0.1. So this is just for now the weight of the second asset be 1 minus the weight of A1. Now the return of portfolio A be the weight of A1 times R1 sample mean plus the weight of A2 times R2 sample mean. So again, this is just a formula for the portfolio. And so I'm going to copy over the variance and standard deviation. Okay. So these are the formulas for the return, variance, and standard deviation of the portfolios, just based on what we already know. And the only key is that we're using these weights, right? Where it has to be between 0 and 1. So the only difference for weight of B would be that we're going to have the sequence go from -2 to 2 to allow short sales. Just the return, variance, and standard deviation that we talked about again. So now we'll plot two portfolio possibility curves. Now we'll have red be short sales allowed, and green short sales not allowed. Okay, so I just wrote the code for the plot. This would be the standard deviation of portfolio B in the X part of that, and the returned portfolio B in the Y argument. So the color would be red for this one because it's the short sales are allowed. We're going to label the x-axis portfolio standard deviation, the y expected returns. PCH equals 16 is just specifying a specific type of the graph. The x and y axis, we're just limiting these. So I already ran this and figured out what the best numbers to limit this were, but you can start by not limiting it and seeing where the values are, but or just kind of guess. This is mainly just to see the graph better. And then we also want to add the points argument to add the non-short sale points. Now we're going to use the AB line function. AB line is just to see where the axes are, so you can just add that to have a line at 0 and horizontal and 0 vertical. Now we need to plot the capital allocation tangent line. So we're going to use plot function, CAL add equals true. I'm going to make the color black for this one. And the line width, we're going to have 4. I just added a code to display the answers for the investment amount, the original question. So 50 million allocated. We multiply that by the weights. We can figure out the optimal amount. So this would be, right, we've taken into account the excess returns. We're looking at regular mean variance optimization. Okay, so after running the code, I realized I messed up this line. So just take another look at that. Make sure you have the correct line 48, the variance covariance values. It should look exactly like this. Column names, the risk premium matrix would be combine risk premium. So once we run it, we can see that the capital allocation line accurately goes through the tangency portfolio and intersects the efficient frontier at a single point. Looks like it's probably around the 0.0085 standard deviation region and 0.0013 expected return. So it looks like 0.13% expected return between these two assets. It's not great. The weights we can see for Cruise 42.8%, Nance 57.1%. So we'd allocate around 21 million to Cruise and 28.5 million to Nance. Okay, so this is just a full screen view of the graph that we just made. As you can see, the green points are the points where there is no short sale allowed, and the red points are the points where there is short sale allowed. And again, where this line, the capital allocation line intersects, those are going to be the optimal weights, the Sharpe ratio maximization weights. So these are our answers. This is our final answer, the amount that we allocated, and the returns and the variances. So this is basically all we would need for that. This is the two asset one. In the next video, I'll go over more than two assets. So we'll go over a portfolio with 5 assets, as well as a little bit more detailed into the global minimum variance, because this one we were focusing mainly on the Sharpe ratio maximization. So this is the end of the video. If you guys have any questions, please feel free to let me know. I hope that this has been useful for you. And if it has, definitely please feel free to leave a comment or like the video or whatever suits you. Thank you so much for listening and have a great night.